Hi there, welcome to kneppyinvests. One of the scans I do on a regular basis is looking for companies whose share price is at least a 6 month high. So I will do a 6 month high share price scan. And at the moment, there's about 73 companies on the ASX that are at least a 6 month high. What I might do in the future is actually scan for 3 month high and then look for those companies that are breaking out, heading towards a 6 month high, because am trying to only invest those companies where there is positive sentiment, some good momentum behind the share price. And I do or am looking for at least a 6 month high. So that's why I'm going to try to focus to the 3 month high and look for those companies that are heading towards a 6 month high. Anyway, in today's video, I'm going to bring you 6 companies that are at least a 6 month high. Some of these companies, in fact, are about a 2 year high since the COVID-19 financial panic. And I will be looking at fairly large cap companies. In fact, a few of these companies, particularly one of these companies, is one of the biggest companies on the ASX. So let's get stuck into it. And the first company we'll be looking at is that really big company. And I wouldn't be surprised to know that that big company is a bank. To be honest with you, I don't really follow the banks all too closely. And the banking sector is one of many sectors, one of many sort of companies where I will buy when I see good value, not particularly when there is good momentum behind the stock price or the share price. Now, NAB's share price is showing, or chart is showing a really good chart at the moment. In fact, among all the banks, including even Macquarie, this is the best looking chart by far. I'm not sure why the market is really intrigued by NAB. Usually when you see the banks compared, particularly the big four, NAB is continually classified as being the lowest quality of those four banks, or among the lowest quality. It's always CBA, and then behind CBA, you're going to see ANZ, Westpac, and NAB in some sort of order. But when you look at the chart for NAB, and this is the yearly chart, the share price is in a nice uptrend, nice positive momentum behind the share price. I just don't think there's a lot of value right now in NAB per se. I think the best time to have bought this company and any of the banks would have been way back just after the COVID-19 financial panic, when the valuations of these banks were really low. I'd probably also say Macquarie Bank is, in my personal opinion, using my personal preferences, would be the better investment. I think there probably would be better growth potential in Macquarie Bank over the next 5 years. So I'm always looking for potential growth in the future, even if there is some positive momentum behind a company. I think with NAB, eventually this positive momentum will whittle away. And we have seen a share price rise in the past month from about $28 to $33. So I think this rapid rise in share price over the past month could be a sign that this run in the share price could be coming to an end. Now, there are some tailwinds and even some headwinds behind the banks with rising interest rates. You'll see their interest margins, I think that's what they call it, actually rise. But you also see bad debts potentially rise as well, as those who have bought mortgages outside of their means of life, means of living, might be or increasingly becoming under stress. So I think usually when you see interest rates rising, that can be good news for the banks, but not completely good news. So that's something else to take into account when you are thinking of buying into the banks. The other thing is the dividend yields. When you see rising share prices, the dividend yields will pull back a little bit unless we start to see some really good growth in profit and they raise the dividends. But over the last 5 to 10 years, we haven't really seen that with the banks. I do think the growth in the banking sector, particularly among the four big banks, has come to an end, and it's going to be really difficult for these four banks to grow in the future. There will be disruptors coming up time and time again. We've seen that with buy now, pay later, and I think we will continue to see disruptors really affecting the profits and profit margins of these banks. So that's another reason to be a little bit skeptical about the future of the four big banks. That's another reason why I do prefer Macquarie Bank over that time frame. Now on to Iluka, and this is a mineral sands miner. So they produce zircon and high-grade titanium dioxide, including rutile and synthetic rutile. So this is a company, sort of company I am interested in because of mineral sands. I do like mineral sands. I have investments in base resources, image resources as well, and both those companies have done pretty well. Iluka is the biggest of those three companies. Because it is the biggest, you do see a lower dividend yield for this company. So I'm more interested in the other two companies just because I think they have more room for growth over the next decade. Plus, I think there is a chance the dividend yield you get out of those two companies could be really good. But really nice looking chart for Iluka over the past year. Share price has been going up and up and up. There's only been a short period during this last year where the share price was looking at possibly turning around into a downtrend. That was towards the end of last year, between September and November. You can see share price falling from about $10 all the way down to just above $8, but the share price has recovered from that. So a nice looking company, nice looking chart. I do like the sector they're in, and the mineral sands companies have been doing well over the past few years. The next two companies are fairly similar in what they do, and we're talking about companies that have supermarkets. The first one is Metcash. So they have the IAG supermarkets, which I very rarely go into. And with Metcash and the next company, which is Kohls, just like the banks, I think there is a time to buy these companies, particularly when the value is quite low. For instance, Woolworths, the time to buy that company was about 5 years ago when the share price was less than $20, when there was negative sentiment in that company, margins were going down. That is the time to buy these sort of companies because very little growth, maybe 2 to 3% growth, if that, and also highly dependent on immigration, those sort of things. Also, we have seen over the past decade, or maybe even longer than that, competitors coming in, Audi, and that could even increase in the future. Just don't know. But at this point in time, right now, some really good positive momentum behind Metcash. Share price is at a 1 year high on the last trading day from when I'm doing this video. So I'm recording this video on the 12th of April. Share price reached a year high on the 11th of April. So nice positive momentum behind the share price. I've also included the long-term trend, which is that sloping dashed line that is from the end of the COVID-19 financial panic. And the share price did pull through that or push through that to the downside twice at the start of the year, but then recovered. So that was not a break in the uptrend. That was sort of a testing, sort of a false break of the trend, but it recovered, the share price recovered. And right now we are at that 1 year high. So nice momentum behind Metcash right now. Nice positive sentiment, nice uptrend. The only thing I have is I think the valuation of these companies could be questioned right now. If I had to compare Metcash chart to Kohls chart, I probably would prefer Metcash chart just because the share price has been an uptrend over the past year. When you look at Kohls, the trend has just turned around in the past few months, but we are now at a 6-month high. We did see the share price pull through $18.20. We did see $18.20 as a high in November, which was 5 months ago. So we pushed through that. We're now at a 6-month high. The last time the share price was this high was way back in August of last year, and we saw the share price reach this level briefly. Now, very important level or price level for Kohls is between $18.50 and $19. That is a real strong resistance level for this company. We have seen that level reached, so that zone reached about 3 times in the past 2 years, and every single time the share price reaches between $18.50 and $19, we do see the share price pull back. Probably lump this company with Metcash. I want to buy Kohls when the valuation does look good. If I had to compare Kohls valuation to, say, Woolworths, I probably would prefer Kohls right now, but Woolworths are doing some interesting things. But I'm not interested that much in these companies because very little growth moving forward, 2 to 3%, as I mentioned before. So not a lot of growth. And the only reason you might want to think about buying these companies is as a defense stock in times of a bear market. Say we move into a bear market, Everyone still buys food, so these companies' valuation will remain better than the overall market in that sort of environment. But probably the only other reason would be if you are an income investor and you just need the dividend yield this company and Metcash, Woolworths do provide. Next company I want to look at is a company I know as Worley Parsons, but I've just found out they've actually changed their name, rebranded themselves as Worley, dropped the Parsons, and this was after they made an acquisition of Jacobs Energy Chemicals and Resources. Now, Worley Parsons is an engineering company. They provide project delivery and consulting services to the resource and energy sectors. I'll be honest with you, I don't know a lot about what this company does. They are fairly old, at least 50 years. I think they were founded in 1971. But the main thing is when you look at the chart, we did see a double bottom. So the price reached $9 twice last September and then again in December. And we've seen the share price really take off from that last bottom of $9. In fact, the share price has increased by more than 50% since that bottom. So the market is really liking what Worley is doing right now. And I might want to do a little bit more research on why there's positive momentum behind this business, why the share price is in a nice uptrend, those sort of things. So this has just entered onto my watch list because the share price is now not only at a 6-month high, well above a 1-year high as well. Last company we'll look at is Calix. This is fairly, I won't say hyped up company, but their market cap is well over $1 billion right now. Revenue in the last half year was only 9 million, loss of 7 million. And I think one of the reasons why this company, or there's a lot of hype behind this company, is just exactly what they do. This is an environmental company. They are into water treatment, aquaculture, CO2 mitigation, cement lime, biotech, crop protection, marine coatings, health and pharma, advanced batteries, advanced cathode and anode materials. So it seems like they're in all the right spaces when it comes to potential growth in the future. That's why I think this company has a fairly high valuation when you compare it to the revenue it is generating right now. So the market expects this company to significantly increase their revenue over the next 5 to 10 years, because if it doesn't, this is well overvalued. Now, I have heard this company being talked about a lot among fund managers, which means there is that hype, and you need the fund managers to increase the valuation of a company to well over $1 billion. There's not many companies that don't need the help of fund managers to drive the valuation up, particularly when you don't have much revenue. So Galax is in the minds of fund managers. There's a lot of hype around this company, but what they're doing is exciting and has a lot of potential for growth in the future. The question is, can they realize that potential into cash flow? That's the most important thing all companies have to do, because the only way a company can be truly valued is taking all their future cash flows and getting the present value of those cash flows. So all companies need to produce cash flows, and that's the only question I have about this company right now. That's all I have for this video of 6 companies with their share price at least a 6-month high. A few of these companies I am fascinated by, in particular Calix. I do like Iluka and even Worley Parsons. I don't know much about that company, so I have to do a little bit more research to see why the market is interested in that company. And 3 other companies I've mentioned in this video, NAB, Metcash and Kohls, are the sort of companies I'd probably prefer to buy when I see good values, not particularly when there is good momentum behind the share price. If you do have any questions about any of these companies I've raised in this video, I'd love to hear your opinion, what you think about those companies, in particular Kohls, Metcash and NAB, why you might disagree with me about why I would prefer to buy these companies at value, why there is good momentum behind the company's share price, why now is a good time to buy those 3 companies. If you know more about Worley Parsons, or Worley, I should call them, I'd love to hear your opinion on that company. Calix, I'd love to hear your opinion on that company as well. So the last thing I should mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.